Welcome everybody. I'm Mike Medrell for TradersHideout.com. The platform that you see, you can actually download for free from www.traders-hideout.com. So let's dive right into our topic. There's a lot of U.S. traders are not allowed to trade using hedging techniques. They need an alternative. Well, what hedging is, for those who don't know, say that you bought, well, I guess we could use Facebook, right? That'd be a perfect example. Say that Facebook starts at $35, okay? And you're one of the millions who bought a couple of shares, and it goes up, okay? And you're really happy. Everything is good. Everything is cool. It's going up. But all of a sudden, it starts going down and down and down and down. You know, and then it went up to, let's say, $40, right? And then it went back to 38 for that day, and then it kept on going down to 34, 33, 32. So in essence, you're actually losing. Your trade was losing money, right? Well, here's what hedging does. Hedging is a trade the other direction from the original trade, meaning that if you placed a buy order, you would create a short order, or a sell as it's called in FOREX, okay? And what that will do is it will cancel out any movements, okay? So let's take a look at an example. Say that we bought Facebook at $35, okay? Or $38 even. That's a great way to start. Started at $30, it went to $40. So we're at $2 profit, right? Everything is really good, right? We think, like the rest of the world probably thought, aside from a few people, that it's going to keep on going up and skyrocketing to La La Land, to the sky, right? Well, those are just fantasies. But anyways, so it did make it to, let's say, $40, okay? So your profit, $2. Now you start seeing it dropping down again, and at $37, you're already in a dollar loss, okay? So what you would do is you would create a sell order or a short order. That means that you're actually betting on that price to go down. Okay, now for every movement, every penny or pip that it goes down, okay, that short order is making money because you're betting on it going down. And that buy order is losing money because it's going in the opposite direction, right? So what that means is that those two orders, they cancel each other out. So the buy order would be losing 1 penny, and the short order will be making that 1 penny. And obviously it'd be the other way. If it goes up, the buy order is up 1 penny, but the short order, because it's going the other way, is now losing a penny. So basically what you're doing by hedging is you're canceling out the differences, okay? It is a protective measure to protect your positions. Now, hedging is not a simple, it's not as simple as it sounds, okay? There's a lot of techniques for hedging. There's actually 2 sessions, complete sessions that I teach how to approach hedging. However, U.S. traders are not allowed to hedge any particular instrument, okay? So they're not allowed to take the U.S. dollar, the euro dollar, sorry, buy it, and then create another order the opposite direction, okay? So you can't have a buy and a short or a sell, okay? You just can't have that. You can only have one. That's problem number 1. By the way, these rulings, you can Google NFA, National Futures Association. It's their ruling, okay? The other ruling that the NFA has is something called FIFO, first in, first out. And what that means is that if you place 2 buy orders, okay, let's say you bought something at $38, and then the price went up, and then you bought some more at $39, okay? As the price goes up to $40, you must close the first order that you made at $38. Okay, because it was the first order in, it's got to be the first order out. Okay, so you wouldn't be able to close that trade that you got in at $39. Okay, that's problem number 2. That's a FIFO rule from National Futures Association. Okay, problem number 3 with NFA, you are not allowed to trade commodities. Okay, oil, gold, and silver. Okay, you could do it through stocks, but you can't do it through Forex. Okay, so those are major issues because part of your portfolio, because the dollar is these days is being devaluated. There's a lot of signs that the U.S. economy is going to hyperinflation and dollar devaluation, staggering rates of devaluation and skyrocket interest rates. So you need to prepare yourself to preserve the value of your money. So if you're holding dollars, you're actually going to be losing money. I'm going to do a session as to the signs for the U.S. economy, which I believe will trigger all these major changes in the devaluation and the hyperinflation. I'll probably do a video later on this week or on the weekend. So what that means is that you should be getting your hands on tangible goods, okay, such as gold, silver, and I mean true gold, not the gold that's stuffed with tungsten that there's plenty of out there, and oil, okay, or another safe haven currencies such as the Swiss franc. Okay, there are a lot of issues with other currencies that they're facing their own issues. For example, the euro dollar is facing a lot of issues because, you know, Greece and Spain and these other countries, problematic countries, that they're starting to be a burden on the EU. With Japan, well, Japan is having their own problems, that's for sure. So I wouldn't look at the yen to be a safe haven for U.S. dollars. So I'll dedicate a session for means for U.S. investors. However, what we're going to concentrate on the next little while is something that is called cross-currency hedging. Okay, what cross-currency hedging is, because you're not allowed to buy and sell, okay, an actual currency, okay, or currency pair, any instrument, you could do it in different ways. For example, if you buy the euro dollar, okay, that means that you're betting per se that the euro will go up against the dollar, right? That's number one. Number two, you could be doing a dollar-yen trade, okay? So you would be shorting the dollar versus the yen. And what that would mean is that you're betting on the yen going up versus the dollar. Okay, so right now, you're betting right now for the dollar to go down, right? Well, here's the issue. You could do a third trade, the yen versus the euro dollar. Okay, but that is not really a full circle because it's two up and one down. Okay, so you need to find the right mix of currencies in order to make that happen. There is a negative side to this, okay, and this is the reasoning why NFA they decided not to allow hedging, okay. They said, which does make sense in a way, but it exposes the U.S. trader to unnecessary risks. What the NFA said is that if we allow hedging, brokers are going to encourage hedging practice because they make more money on the spreads, because every trade you make, the broker makes money, right? So a lot of people are going to be making hedge trades. Well, you know what? That part is true. Brokers will try to get people to make more hedge trades. But you know what? I think they'll look at it the wrong way, because the trader needs to protect himself. And they forgot about the trader. The NFA did a piss poor job of protecting the trader, because now the trader is liable for a lot more risk. Okay, they're just exposed to more risk because they cannot hedge their trade. They need to simply close out a loss. So that's a problem. So my personal view is that there is the NFA ruling is incorrect, and it should be reversed at some point. There are other reasons for them doing it, but that is the major reason. So let's have a look at a mix, what sort of a Confucius combo we could put together to make hedging possible. Now, remember that every trade that you make, you're actually going to be spending money making it in terms of spreads that you have to pay. Okay, but really the bottom line is you want to protect your investment. Okay, so let's say that you opened a euro-dollar trade, a buy euro-dollar. Great. All right, well, euro's going up versus the dollar. Everything is good. Okay, right now the dollar is actually getting strong. It's 125.64. So let's say we got it 125.64 and we're doing a buy. Okay, so it goes to 126. It went up 55 pips. Everything is good. Okay, and all of a sudden it starts dropping. Well, if you're a scalper, you just close the trade and you say, hey, this is great. That's what I wanted. Again, this is trading style dependent. If you're doing scalping, cross-currency hedging is not for you. That's from personal experience. If you're doing any such thing as swing trading or long-term trading, that you could use that, sure. Because you're not in and out, in and out, in and out, and you're not just creating a lot of trades that you're paying the brokers for. Okay, the whole idea here is also to keep your costs down, the profits up, and the risk low, right? So perhaps on some intraday, if you're doing some very large volumes, if you're a large trader, then what you would want to do is that you want to take, let's say you got $100,000 in your portfolio, and there's obviously some basic rules. You're not going to expose over 5%, and you decide to put that in the euro dollar. Okay, so you put $5,000 into the euro dollar, and it goes up and up and up. So we're at 120, 1.26. You made your 45 pips or whatever, and then it starts going down. You could do two things. Well, because you cannot hedge, right? What you need to do is you need to get other currencies that will stabilize or offset the losses that you're about to incur. Okay, why? Because you think that over time you're going to be making another 300, 400, 500 pips. If you're doing a long-term trade, or possibly you're expecting a move based on news, which is fine. But say that you need to protect your trade for a specific time period. So you would look for other pairs that you would know that if the US dollar goes down, they would be a safe haven. For example, the Swiss franc is still considered fairly a safe haven. So you could do something in the lines of short US dollar versus the Swiss franc. Okay, and what that would mean is that while your euro dollar is going down, okay, because the dollar is getting stronger, then because you actually shorted the dollar versus, sorry, went the other way. You short you buy, hold on, let's do a reset. You did a buy US euro dollar, so that means that you're buying euro dollars versus the dollar, okay? But if it goes down, then that means that the dollar is getting stronger, okay? So you're actually betting against your own currency. Now, the Swiss franc, obviously, is if the dollar is getting stronger, chances are the Swiss will get weaker versus the dollar as well. So you would be doing a buy on the US dollar versus the Swiss franc. Okay, so as that buy starts going down on the euro dollar, and it goes down, okay, your US dollar franc, your Swiss franc, will start going up. Okay, and what that would mean is that for every pip that you're losing on your euro dollar trade, you're actually making it up on the dollar Swissy. Okay, which is pretty cool. So that means that you're offsetting. You're doing like a cha-cha. Okay, which is really good. So I'll just say that again. You know, for those of you who are having a little bit of a problem grasping it. So I got this euro dollar. Okay, I bought it at 1.2565. Okay, and it went to 1.226. It went up 35 pips. Okay. 1.26, everything is good. We're making money. We made 35 pips. All of a sudden, it starts going down. Okay, so I would create a buy dollar Swiss. So I'm buying dollar against the Swiss. So for every pip that I'm going to lose on my initial trade of the euro dollar, I'm going to be making it on the other side when I'm buying the dollar versus the Swissy. Okay, now when you start seeing the euro dollar come back up versus the dollar, then you could close that winning trade that you have, the dollar versus the Swiss, take the profit on that, okay? And then once again, when the euro dollar goes up, then you can take the profit on that. Now, it sounds nice, it sounds simple, but the timing is everything. Because if you don't time it right, you could have 2 losing trades instead of 1. Okay, so hedging is an art and a science put together. Okay, and I have 2 sessions explaining how to hedge. Okay, now hedging for scalpers is completely different than hedging for swing traders and long-term traders. The mentality is completely different. Okay, although you could trade that way, but the whole idea for an alternative for a U.S. trader, because you cannot hedge, you could have 2 separate currencies and do that. Okay, so this is what this session is all about. If you have questions, feel free to, if you're on YouTube, feel free to ask it through the comments, through the live comments, and I'll answer them. I'll be more than happy to answer it. Now, obviously, this could be done with any currency, okay? It doesn't have to be the dollar. I just gave that as an example. While we're on this topic, I do want to talk a little bit about oil, gold, and silver. Because for oil, gold, and silver to be traded, if you want to buy them, you need US dollars. Okay, so that means if any other trader aside from the U.S. wants to buy oil, gold, and silver, they need to convert their currency first to US dollars and then buy that commodity. Okay, as long as oil will be traded, okay, and this is like a pact made between OPEC and the U.S. As long as OPEC will sell their oil in dollars only, okay, that's why it's called petrodollars, then the U.S. economy should be okay, fairly okay. The minute that you will start seeing multi-currency trading with oil, that's the day that the U.S. economy is going to start being really shaky. Okay, again, I'll do that in another session. But what that means is that if you want to buy oil, you could be doing it by looking at the countries that are actually buying the oil. Okay, for example, let's say Japan right now needs oil. Why does Japan need oil? Because they shut down all their nuclear reactors, okay, because of the issues that they had. So that means that they're buying dollars left and right because they can't buy it with yen. So they need to substitute all the yens for the dollar. Okay, so that means that if you're going to buy the dollar versus the yen, that's probably a good trade. Okay, again, this is not for a 5-minute trade. It's more for a long-term trade. Okay, so remember that in order for countries to buy gold or oil or silver, they need to pay dollars. Okay, and that is something right now that is holding the U.S. economy. And as long as those commodities are going to be sold in U.S. dollars, then the U.S. economy will be fairly okay. Having said that, I would like to put 2 little tidbits of information here. China, as of last year, allows Chinese residents to place gold bars into their bank account like it was normal money. Okay, so that means that at the end of the day, the gold bars are reevaluated at par value with the price of the gold that day. So what that means is that right now Chinese are stocking up on gold, and they are a lot of them. And China is buying pretty much all the gold it can get. Okay, the minute that they get all the gold or most of the gold reserves, and other countries are doing that too. Right now there's a race for the gold bars. What will happen eventually is that the need to buy gold is going to be, it can't be sustained, right? So what that will do is that people no longer need to buy dollars. That means that the presses that print out the dollars need to stop, right? Because there's nothing holding those dollars going out aside from oil. So again, that's a separate session, but as long as you're getting things that are different currency, and you know that they need something that is sold in dollars, you could trade that. So it's not the same as trading the commodity itself, but it's like a side way to do it. Okay, so hopefully this information was useful to you, especially if you're in the U.S. Obviously, everybody in the world can do cross-currency hedging. And if you want more information on cross-currency hedging, you're welcome to come to my hedging sessions. Feel free on Google Plus to add me, plus Mike Medrell, and subscribe to the Traders Hideout channel on YouTube. And the platform that you're seeing on the screen is you can download it for free, completely free, from www.traders-hideout.com. I wish you that may the profits be with you, and we shall see you on the next video. And later on today at 7 p.m. Eastern Time, there will be another live trading session. So we'll see you then.